Next paragraph, reacquired rights. What is the meaning of reacquired rights? A had allowed B to use its trademark and they charge some consideration for it. A acquired B. So this trademark will also get acquired now. Is it right? So this transaction with respect to trademark will also needs to be accounted now. So this we will call separate transaction. This we will call a separate transaction, because this is a pre-existing relationship. This is called pre-existing relationship. And for pre-existing relationship, this will be treated as a separate transaction, separate from the business combination transaction. So then we will have to see, is there any liability appearing in the books of A with respect to this trademark, because you might have recorded the consideration received for transferring the rights, and which you might be amortizing over a period of number of years. So check that, and then you record it at fair value, but that fair value will be based on remaining number of years. Fair value will be based on, because now this right you have reacquired. So if suppose it was given for 5 years, the valuation will be based on remaining number of years. 2 years are over, 3 years are remaining. So you do the revaluation of these rights at 3 years. And then you will amortize it over that 3-year period as an intangible asset. In case in between you sell that right again, then it will be recognized as gain or loss. There is one example also, but not now, after some paragraph. So what are reacquired rights? These are the rights which the acquirer before acquisition may have granted to the acquiree to use certain assets which belong to the acquirer, like this trademark right, brand name, license, franchisee rights. It does not matter whether the asset was recorded in the financial statement of the acquirer or not. Possible? If I give franchisee rights to somebody who wants to run our virtual center, he can, even though this franchisee is not appearing as an asset in our books, it is a self-generated asset. But we have charged 1 lakh rupees for that franchisee rights. It is for 4 years. So it does not matter whether the asset was recorded in books of acquirer or not. If an acquirer acquires an acquiree, tongue twister, acquirer acquires an acquiree which had certain rights granted to it by the acquirer, then the business combination results in settlement of the right, and accordingly any settlement gain or loss should be considered as a separate transaction from business combination. Underline. This settlement will be treated as a separate transaction, separate from business combination transaction, because it is based on pre-existing relationship and will be recorded in the financial statement of the acquirer separately. The only point of taking this discussion is, suppose you paid a total consideration of 100 crores, and suppose it includes a compensation of 2 crore for reacquired rights. Possible? Because you have taken some payment from them for 5 years, and now this 5-year period is not over. Before that it was acquired. So then sometime there can be a clause that in case if the rights are taken back, the acquirer will pay or the party will pay a certain amount. So what I will do, this 98 crore rupees will be treated as consideration for business, and this 2 crore will be accounted separately. Now what about the measurement? The acquirer shall measure the value of reacquired rights recognized as an intangible asset on the basis of remaining contractual term of the related contract, without considering the effect of potential renewal. Now again here the IFRS body had invited the comment from people, should the value of this reacquired right should be based on remaining contractual term, or should it be based on the assumption that the rights can be renewed? So what they have concluded, that we will only value it on the basis of remaining contractual terms. You have now reacquired those rights. So you will not renew it with yourself. That is how probably they have put the logic, and therefore the answer is it will be valued on the basis of remaining contractual terms, not on the basis of the assumption that the rights can be further renewed, because the valuation would be different if you assume only 3 years, if you assume 30 years. But you can sell the rights, and if you sell it, gain or loss will be recognized in profit and loss. Can we recognize intangible assets in business combination separately from goodwill? The answer is yes. And this is really interesting. When you acquire other entity nowadays, it's mostly you pay for tangible or intangible asset. To a large extent now the consideration is paid towards intangible assets. What you do, make a list of those intangibles which are identifiable separately from goodwill. How do you know it is separately identifiable from goodwill? Apply these two tests. Either it meets separability criteria, which again we'll discuss below in detail, or it meets contractual legal criteria. What is a separability criteria? It can be separately rented, exchanged, sold, transferred, etc., either individually or in combination with other asset. Okay, but other than goodwill. Or there must be a contractual or legal criteria. For example, a license to mine, a license to broadcast, license to collect toll on highway, etc. So if these rights arise due to contract or legal reasons, then it is a separate identifiable intangible asset and will be recorded separately from goodwill. But if you can't prove these two conditions, either of these two, then it will get merged with goodwill. Because as you know, goodwill is the balancing figure in business combination. Next paragraph is share-based payment transaction. Now this I will not again repeat. Apply IFRS 2. If you have to measure any liability or equity, what is the difference? If there is an obligation to pay cash, like stock appreciation right, then it is accounted as a liability. Or if there is an obligation to issue equity share, then it is accounted as equity instrument. This standard IFRS 2 discusses about the valuation of liability and equity instrument relating to share-based payment transaction, so that we will follow. and I have separate long paragraph on this share based payment transaction also. Next item which we have a difference treatment is asset held for sale. Students will remember in IFRS 5 also there is a similar paragraph. Usually asset acquired in business combination is measured at fair value. But if the objective of acquiring this asset is to sell it immediately, it meets the definition of held for sale, then the standard says hold, don't value it at fair value. You value it at fair value less cost to sell. So you may acquire some asset from the acquiree, but you don't want to use it. Okay. So you want to sell those assets which is you think is not useful to you, not required. What about operating leases? In operating leases, suppose acquiree is a lessee. Acquiree, from whom we have acquired the business, he is a lessee of that asset. He is a lessee of that asset. So as you have studied somewhere before, that operating lease, no assets or liabilities are recognized. If it is an operating lease, there is no asset or liability appearing in the books of lessee. Whenever they pay the rental, they charge it to profit and loss. But the standard says, check the terms of the operating lease agreement. Check the terms of the operating lease, because now you have to honor that operating lease agreement. And the terms of the operating lease agreement may be favorable or unfavorable on the date of acquisition. If it is favorable, record it as an intangible asset. And if it is an unfavorable, record it as a liability. What do you mean by favorable, unfavorable? Suppose you have entered into a contract to pay 2 lakh rupees per annum. This operating lease the lessee has already entered into. Now if I take the same asset on lease, it is available at 3 lakh rupees per annum. So that means this contract, this lease contract is going to be beneficial for the lessor. In this example, acquirer. Okay, acquirer. So acquirer will show this 1 lakh, of course subject to calculations, present value, etc. They will show it as an intangible asset and then they will amortize it. But it is also possible market lease rental for similar asset is 1 lakh, but you have a contract to pay 2 lakh. So this is unfavorable. This you record it as a liability. Now next situation is acquiree is the lessor. Acquiree is the lessor means where is the asset? The asset is appearing in the books of acquiree. So the standard says if the acquiree is the lessor, then no adjustment is recorded for the asset which is recorded in the financial statement of the acquiree. However, the lease rentals are considered for determining the fair value of the asset. So in case if you are getting higher lease rental than the market, so it will increase the fair value of that asset because the value in use or the future cash flow will be higher. So what they are saying, only consider the lease rental and use that for fair valuation of that asset. Now next is what about assembled workforce? Manpower, including women power. Is it right? These are the resource of the organization. Will you disclose or record them also as asset? No. Why? There is no control. An assembled workforce is a collection of employees that permits the acquirer to continue to operate an acquired business from the acquisition date. So actually you are paying for this also in your business combination purchase consideration. You don't have to take efforts to find employees, train them. Okay, that is a big cost in the organization, and that takes a lot of years to have a strong team. Here you are getting it ready-made. But again, because these are human resource, you do not have control over them. It will not be recognized as a separate asset. But indirectly, they get recognized because the amount will get adjusted in goodwill. Because the assembled workforce is not an identifiable asset to be recognized separately from goodwill, any value attributed to it is subsumed in the goodwill value. Unearned revenue means the other party, acquiree, has some unearned revenue, some revenue they have not yet recognized. Unearned revenue arises because of the application of revenue recognition criteria applied by the acquiree. Like when you apply percentage completion method, some revenue may remain unrecognized, unearned. So apply which standard here? Apply which standard for unearned revenue? 115, only 15. IFRS 15. It should be evaluated whether there is any obligation on the acquisition date to be fulfilled, and accordingly an asset or liability against it will be recorded. So refer IFRS 15. So in the last about half an hour, we discussed exceptions to general rule that assets and liabilities will be recorded at fair value. Okay. So now which all exceptions we have discussed, there is a small summary prepared here. All these exceptions are limited, number one, only to acquisition date accounting. Okay, not in general. An asset or liability otherwise which would not have been recorded gets recorded. So example is contingent liability. Okay, or you can add one more example, intangible asset. Intangible asset also gets recorded, which otherwise would not get recorded. Self-generated intangible assets. Certain intangible asset you can write. And the second point here on the top is the assets and liabilities are measured at a value other than the acquisition date fair value. And here we have two types which affect both recognition and measurement, and which only affect the measurement. Which affect recognition and measurement: income tax, employee benefit, indemnification asset, operating leases. And which affect which affect only measurement: share based payment, asset held for sale, and reacquired rights. Now some more discussion on intangible asset. Business combination basically aims at increasing your future revenue, future profit, future growth, and that too quickly. Is it right? You can always acquire tangible asset easily, but what you cannot acquire? The intangible assets like the brand name, the copyright, the trademark, the intellectual property rights, technical know-how. So in that case, the question will arise, should we recognize intangible asset as separate asset, or should it be recognized as goodwill? If any of the two conditions are satisfied, then intangible asset will be recognized as a separate asset. Goodwill will be the balancing figure after recognizing the intangible asset. Test number 1, separability criteria, or test number 2, contractual legal criteria. Okay. So first we will focus on contractual legal criteria. That means there is a contract or there is a legal right and under which you have acquired that asset. Then this will be shown separately. An intangible asset that meets the contractual legal criteria is identifiable. Now, if it is contractual legal, then you don't have to apply separability test. That itself is enough. Okay. Like mining license you have got from the government. So that itself is a legal right. Now you don't have to further test whether I can separate it, I can transfer it, etc. etc. That is enough. Even if the asset is not transferable or separable from the acquiree or from other rights and obligation. Now see this example, ABC. 3 examples are written. For an acquiree, leases a manufacturing facility under an operating lease that has terms that are favorable relating to the market terms. This example we discussed earlier also, but now this will be also discussed as an intangible asset. You have a contractual right. Lease means a contractual right, okay? And this right has turned favorable. The lease term explicitly prohibits transfer of the lease through either sale or sublease. Question is whether this lease, which is favorable, will be treated as intangible asset. So you will say yes. Okay. There is an intangible benefit of acquiring this company, acquiring company, because along with that acquiring company will get a lease contract and which is favorable. So the amount by which lease terms are favorable compared with the terms of current market transaction for same or similar items is an intangible asset that meets the contractual legal criteria for separate recognition from goodwill, even though you cannot sell or otherwise transfer the lease contract. One more good example. An acquiree owns and operates a nuclear power plant. My God, who does it? Nuclear power plant. What do they manufacture there? Nuclear bomb or power? Nuclear power. In next few years or decades, most of the world would be using the nuclear power energy because it is clean, cheaper also. The only risk is that if that power plant has a leakage problem, then all people around that plant will may die. Not die, but may die. So that is the reason they don't emphasize on this energy source right now. Why I am giving you general knowledge? Come to second line. The license to operate that power plant is an intangible asset. License to operate. Now the moment you come across these terms like license, rights to operate, etc., do not treat further. It is an intangible asset because there is a contractual legal criteria. Separately from goodwill, even if you cannot transfer this license to any other party, such licenses are not transferable because the government, after all careful due diligence, will give this license to certain entity only, and then you cannot easily shift it to others. Acquirer may recognize the fair value of the operating license and the fair value of the power plant as a single asset for financial reporting purpose if the useful life of those assets are similar. So either you treat it as one asset or you can treat it as two assets. You can treat them as one asset if useful life are same. One more question. An acquiree owns a technology patent. Acquiree owns a technology patent. So again, it's a legal right because only you can use that technology. And then second thing, what they have done after getting this patent, it has licensed that patents to others. So now what you have started doing, you have licensed to others also for their exclusive use outside the domestic market, receiving a specified percentage of future foreign revenue in exchange. Understood the business model? You develop the technology. Let us say it's a software, tally software, accounting software. Get it patented. And then what you do? You start selling the license to use that software. So there are two intangible assets here. Which two intangible? Patent and the licenses. Both the technology patent and the related license agreement meet the contractual legal criteria for recognition separately from goodwill, even if selling or exchanging the patent and the related license agreement separately from one another would not be practicable. Now we'll come to separability criteria. When is an intangible asset separate from goodwill? Intangible asset is separate from goodwill if it can be sold, transferred, licensed, rented, or exchanged either individually or together with related contract, identifiable asset or liability. Then it is called separable criteria. If either individually or with a group of asset it can be transferred. An intangible asset meets the separability criteria even if the acquirer does not intend to sell, lease, license or exchange. What you have to demonstrate at the time of recognition? Ability to sell, exchange. You don't have to prove that I am actually going to sell it. Okay. An acquired intangible asset meets the separability criteria if there is an evidence of exchange transaction for that type of asset. Now here you may find it difficult to prove the separability. So what you have to tell to the investor that there is a history of such intangible asset being sold. Even if those transactions are infrequent and regardless of whether the acquirer is involved in them. Now see whether this question is printed in your book. Question number 18. Okay. Question number 18. Company A, FMCG company acquires an online e-commerce company E with the intention to start doing retailing. E-commerce company has over the period of 10 million registered users. However, the e-commerce company E does not have any intention to sell the customer list. Should this customer list be recorded as an intangible asset in a business combination? Only yes. Is it a legal or contractual right? No. You have generated it in-house over a period of time. Is it right? Can it be separated from goodwill? Yes, because that list can be sold. If you don't intend to sell, that does not change the criteria, the characteristics of that list. So therefore, the answer is the ability is important. Intention not to transfer will not affect the assessment, whether to record this as an intangible asset or not. So write down the answer in 3 lines, 3 or 4 lines. In this situation, the customer database does not give rise to legal or contractual right. Accordingly, the assessment of its separability will be assessed. Accordingly, the assessment of its separability will be assessed. So if you don't meet the contractual legal right test, apply separability test. Check whether you can separate it, exchange it, rent it, sell it. Accordingly, the assessment of separability will be assessed. The database can be useful to other players. The database can be useful to other players and E has the ability to transfer this to them. And E has the ability to transfer it to them. Accordingly, the intention not to transfer will not affect the assessment whether to record this as an intangible or not. Come to paragraph number next. Reacquired rights, already discussed. These are the rights which were earlier given to acquiree, and now the acquirer reacquires it from acquiree. Acquirer reacquires from acquiree. This will be treated as a separate intangible asset, separate from goodwill. It is based on pre-existing relationship. Okay. Example: a right to use the acquirer's trade name under a franchisee agreement, or a right to use the acquirer's technology under a technology licensing agreement. And then once you acquire that entity, the pre-existing relationship gets settled. So the standard says reacquired right is an identifiable intangible asset that the acquirer recognizes separately from goodwill, and you treat this as a separate transaction also. Okay. So if your purchase consideration includes some amount paid for this, remove this much amount from total purchase consideration, and then you do the business combination accounting. This you account is as a separate transaction, separate from business combination transaction. If the terms of the contract giving rise to reacquired rights are favorable or unfavorable relative to the terms of the current market transaction for the same or similar item, the acquirer shall recognize a settlement gain or loss also. So if there is a difference between the market value and the terms of settlement, that difference will be recognized as gain or loss. So for you, the accounting will be at 4 lakh, but the settlement amount may be 5 lakh rupees. Okay. That 1 lakh rupees gain or loss will be recognized. One small example is printed there. Solve on your own. First you will try, then you will copy. Vada Pav Limited. What is the name of this company? Vada Pav Limited is a successful company, has number of own stores across India, and offers franchisee to other companies. Efficient Limited is one of the franchisee of Vada Pav Limited and operating number of stores in South India. Vada Pav Limited decided to acquire Efficient Limited due to its huge distribution network and accordingly purchased the outstanding shares on 1st April 20x2. On the acquisition date, Vada Pav determined that the license agreement reflects the current market terms. So what is the question? What will be the treatment of this reacquired franchisee rights? Okay. So it will be measured at fair value based on the remaining period. Okay. So write down 1 or 2 lines. And then the total purchase consideration will be allocated separately to Vada Pav or this franchisee right. Gain or loss will not be recognized because the standards, the question says, on the acquisition date, the Vada Pav determined that license agreement reflects current market terms. Vada Pav Limited record the franchisee right as an intangible asset, that is reacquired right, while doing purchase price allocation. While doing purchase price allocations, and since it is at market terms, no gain or loss will be recorded on settlement. Since it is at market terms, no gain or loss will be recorded on settlement terms. So total consideration will be allocated towards business combination and towards reacquired rights. So reacquired rights debit to bank, that portion, and this is your purchase consideration, net asset acquired to consideration. This will affect your goodwill or gain on bargain purchase calculation. Okay, now dear students, some number crunching will start. This chapter had a lot of theoretical background. So next one or two question numbers. Business combination usually will give rise to goodwill, usually, but not necessarily. Sometimes your luck is good, so you will have a bargain purchase. Bargain purchase means you pay less, you receive more. But in general, you pay more and you receive less than what you have paid for. And since you are not acquiring just some assets or group of assets, you are acquiring a whole business. A business is an integrated set of activities. So many years of hard work that is required to create a business, you don't have to do that. Plus, there are existing relationship with suppliers, customer, employees, okay, and therefore the acquirer gets the benefit of the pre-existing relationship of that enterprise with so many stakeholders, and that is what you have to pay for extra. That extra is called goodwill. Is it right? If possible, you identify all tangible and intangible assets separately. But if you can't identify assets separately and still my consideration paid is more, then the difference has to be allocated to an asset called goodwill, right? Goodwill is the most important asset of a business because it helps you to generate additional revenue. Anyway, now we'll come to the calculation part. This is going to be there in almost every problem. Goodwill, whether you have NCI or whether you don't have NCI. Goodwill calculation. First, you take total of these three items, aggregate of purchase consideration transferred at acquisition date fair value. You can do it. Already we have discussed, we have to add cash transferred, share transferred, contingent consideration, deferred consideration. So add all of this at fair value, subject to if there is any exception mentioned in the earlier paragraph. Then the amount of any non-controlling interest, in the acquiring measured in accordance with this IFRS. So add NCI also. Two options are allowed to you, either at fair value or at proportionate share in the net asset of the acquiree. And if you are already holding some equity interest in the acquiree, add that also, okay, at fair value. In case of business combination achieved in stages, the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. So this you will add. The logic of this entire thing is that suppose you have acquired right now 60%, non-controlling interest hold 20%. You are already holding 20%. So the total of A is approximately the fair value of 100% equity interest. Is it right? And compare that with the net of the acquisition date amount of the identifiable asset acquired and the liability assumed. So we will call them INA, identifiable net asset. Okay, short. INA, identifiable net asset. This is again 100% of the company. This is what we are acquiring, V plus non-controlling interest. And this is what we are getting. This is what we have paid. This is what we have got. So the difference between A and B, if positive, is treated as goodwill. Is it right? Goodwill will be calculated on the date you acquire the control. Suppose in future, I acquire 5% share from this non-controlling interest and my share become now here. Already we had 85% now. Huh? Now I don't have to calculate again 5% goodwill for 5% because already we have acquired the control when we acquired this lot. So goodwill will be calculated on the date of acquiring the control. If in future you acquire some more percentage, sell some more percentage, then don't adjust the goodwill because you are already controlling that other entity. Is it right? Now if I am acquiring 5%, I am not paying premium for getting that control benefit. I am only going to share extra profit now. I already have the control. So this standard says then subsequently if you increase your stake or decrease your stake, don't adjust the goodwill. Take this goodwill only. And what will you do with this goodwill? This goodwill will be tested for impairment annually. This goodwill will be tested for impairment annually. Goodwill is not amortized. Tested for impairment annually, even if there is no indication of impairment. And second point is goodwill is not amortized. Goodwill is not amortized. Okay. And what about if B is greater than A? Gain on bargain purchase. This will be transferred to P&L account as a gain, as a profit. This is P&L account. So this standard says if there is a gain on bargain purchase, you got a good deal. Okay, you got a good deal. So this is your gain, recognized in P&L account. Some other standards like Ind AS in India says you transfer it to capital reserve. But in IFRS there is nothing like capital reserve account. Okay, that is Indian creativity. So this is simple, transfer it to P&L account, forget. Now just solve this small example. Is it printed somewhere or you have to write? entity A acquired 15% of entity B in 2009 for rupees 10,000. In 2010, it acquired further 60% stake. Consideration paid 60,000. Entity A identifies the net asset of B as rupees 80,000. Fair value of 15% share is rupees 12,500. Okay. Now this question has not given you the fair value of NCI. Is it given? One can calculate it also, or one can simply take the fair value of net asset. Okay. How you can calculate the fair value of NCI? One argument can be like this. For 60% stake, consideration paid is 60,000. So what is the NCI stake? 25%. 15 is already held by the entity A. So 25% is 25,000. The other way you can simply calculate net asset is given 80,000 into 25%, 20,000. Is it right? So which one you want to use? Net asset. Share in net asset. Every question can have two answers in this chapter if there is an NCI involved. So have you written the question? You want to write or just understand? Understand only. ठीक है. Understand. So the question is, you are already holding 15% stake. Its book value is right now 10,000. You acquired 60% stake. You paid 60,000 for it. And the net asset of this acquire is 80,000. So the standard says if you are already holding some stake earlier, all those earlier held stake will be fair valued. Okay. So 12,500 I will take for 15% stake plus 60,000. NCI I will value at 25% of INA in identifiable net asset. This total will be compared with INA, identifiable net asset. The difference in this example is goodwill. 60,000, 20,000, 12,500 total minus 80,000. Is it 12,500? Say yes or no. You can take NCI at fair value also. In that case, your answer will be how much? 60% 60,000, 25% 25,000. So therefore, your answer will become 25,000 here, and this goodwill figure will be 17,500. Under this method of goodwill calculation, where you have valued NCI using proportionate share in net asset, the entire goodwill is attributable to parent. The entire goodwill is attributable to parent. So in case in future if you have to impair the goodwill, who will bear the loss? Only parent. But if you value NCI at fair value, then goodwill will be proportionately allocated to the two, and in case of impairment, it will be proportionately allocated to the two party, parent and NCI. Okay. Next paragraph. In a business combination in which the acquirer and acquiree exchange only equity interest, then the acquisition date fair value of the acquiree's equity interest, if more reliably measurable, then the acquisition date fair value of the acquirer's equity interest. Then in that case, the acquirer shall determine the amount of goodwill by using the acquisition date fair value of acquiree's equity interest instead of acquisition date fair value of equity interest transferred. They could have just simply said, take the fair value of equity of acquirer or acquiree, whichever is more clearly evident. Okay, for the purpose of calculating the goodwill, in case of only equity exchange, whose equity fair value we should take? The one which is more clearly evident. And what about the calculation of goodwill when there is no consideration transferred? Like this will happen, for example, if you have some stake in the company, that other company goes for buyback of share, and after the buyback you are now holding more than 50% share. So what you do, on the date you acquire the control because of this transaction, take fair value of that stake for goodwill calculation, right? Check this question in the list of questions printed at the end. If it is printed, you will not have to write. Question number 30, just for quick practice, orally. A Limited acquired B Limited on payment of rupees 50 crore cash and transferred a retail business also. Even transferring a business will form part of consideration paid, the fair value of which is rupees 30 crore. So what is the total consideration paid? 80 crore. Assets and liabilities assumed 72 crore. Find out goodwill. 50 mark question. How much? 7 crore. 8 crore. So just write down goodwill equal to 50 plus 30 minus 72. Okay, now check whether this question is also there. Question number 34, I think. Not 34. 31. Just below that. Question number 31. A Limited purchased 60% share of B, paying rupees 1050 million. Number of share capital issued is 1 million. Fair value of identifiable assets of B Limited is rupees 1280 million, and that of liability is 100 million. As on the acquisition date, market price of B Limited share is 1550. So if the market price is given, then you can do the fair valuation of NCI using market price. Find out goodwill. Now this question can have two answers. So that is why in the exam you have to take a stand and solve it. So case 1, write down case 1. Case 1, goodwill is measured using NCI at fair value. If you take fair value of NCI, so then my calculation would be like this. Fair value of consideration paid, check, is it 1050? 1050. Fair value of NCI. NCI is holding 40% of 1 million share into 1550. Since we are writing in million, is it 620? Check 620. So the total of 100% stake is 1670. Net asset 1280 minus 100 is 1180. Therefore, goodwill in this example will be 490. And then you will write a note that goodwill is measured using NCI at fair value. It is termed as full goodwill. It is termed as full goodwill. It is termed as full goodwill. This is case 1. Can I solve it by other way also? Yes. What is the answer in that other example? Suppose I take NCI at proportionate share of net asset. Now check the answer. Case 2, NCI is measured at proportionate share of net asset. Fair value of consideration paid 1050. NCI will be now 40% of 1180. 1180 I have already calculated in my previous case 1, 472. Take total 1522 less fair value of net asset 1180, and therefore goodwill is 342. What is this goodwill known as? Partial goodwill. Goodwill calculated in this manner is known as partial goodwill. So when NCI is measured at proportionate share of net asset, goodwill is termed as partial goodwill. So this goodwill is allocated only to parent, okay, acquirer. So if you have to impair this goodwill, you will write off it against the parent's profit and loss. Now come to bargain purchase. Good deal, fair deal in your favor is called bargain purchase. That is, you pay less and you receive more. That is bargain. Okay. Now, generally, bargain purchase is not possible. Why generally bargain purchase is not possible? Any idea? Because you are not selling asset, you are selling a business. Individual asset, if it can be sold for 100 rupees, the business must be sold for more than 100 rupees. But still, somebody may be in crisis. Take advantage of his crisis. Okay. The government says Indians cannot work in China. Chinese government says. But you have already started your business in China. So you have to sell your business and run away. Otherwise, government will take over whatever it is there. So you will sell it at 40% of the net asset value only. Okay. Sometimes the regulation may require that you have to sell a business. Okay, in some countries the government says you have to sell that business, you have to pay the dues of the bank. What will you do? Sell it at bargain purchase amount. We are the student, whatever may be the reason. In this standard, we do not differentiate the reason. Credit it to profit and loss if there is a bargain purchase. In extremely rare circumstances, an acquirer will make a bargain purchase in business combination in which net asset value exceeds the PC, purchase consideration. The acquirer shall recognize the resulting gain in profit and loss. And one more thing, in case of bargain purchase, the gain will be attributed only to the acquirer. It is your decision. You have acquired, so you are benefiting. Do not allocate any gain to and say what is his role. He is getting fair value. So gain will be allocated to the parent company only. A bargain purchase might happen, for example, in a business combination that is a forced sale. Okay, forced sale means you have no choice but to sell it. Like for example, you have taken a bank loan. You have not paid. Police is after you. Interpol is after you. Government is after you. So what will you do? Go to jail or sell some business, raise money and then protect yourself? Jail. Jail is also okay. At least you should have that experience once in lifetime. Okay. Although it is not a good experience, but okay. So when there is a bargain purchase, the IFRS standard says, wait, stop. Check all calculation again. Check all calculations again. Be doubly sure. Be doubly sure that it is really a bargain purchase. So check fair value of consideration transferred again. Check fair value of the net asset acquired again. Check fair value of non-controlling interest again. And if after rechecking also, you come to the conclusion that it is a bargain purchase, then yes, you can recognize it in the profit and loss account. Okay. Now first you tell me whether this question is there in the list or not. If not, ignore it. I have put many questions. No, ignore. Now this come to example 12 printed below. On the same page, below that bargain purchase, there is an example, a case study. Entity X is one of the largest liquor manufacturing company in the world, and it acquires another entity Y which has significant presence in India and UK. However, the Competition Commission in UK has issued orders to sell one of the divisions of the UK assets of entity Y in order to comply with the local competition regulation in UK within a specified timeline. So this is a regulation. It is forcing you to sell one of your businesses. It says you can't become so big an entity. Is it right? No, there's nothing to laugh. In India also we had similar law. CC law, Competition Commission, Competition Act, na? Before that there was MRTP also. So in MRTP Act also we had a similar provision. You can't become bigger entity beyond a limit. MRTP, Monopolies and Restrictive Trade Practices Act, MRTP, in India. So earlier Bajaj Auto Limited used to manufacture two-wheelers, Chetak and some more, Super. So they had a waiting list of 1 year, 2 years. Can you believe? And the reason is that they are not allowed to increase their capacity. Okay? Same thing happens in many other businesses. Government does not allow you to become too big. So you have to sell some asset anyway. So what we will do? We'll do accounting. Z, another boutique liquor manufacturer, realizes the opportunity. Very good. And purchases the asset of entity Y from entity X. Now you are forced to sell this business because of regulatory reasons. In the given case above, it is more likely than not that there could be an element of bargain purchase, as the entity X was under compulsion to sell the asset within a specified timeline. So when there is a deadline, you have to sell it as fast as possible. Before recognizing a gain on bargain purchase, what the acquirer will do? Acquirer shall determine whether there exists a clear evidence of underlying reasons for classifying the business combination as a bargain purchase. So recheck all your calculations. And if such evidence exists, the acquirer shall reassess whether it has correctly identified all assets acquired, all the liabilities assumed, and shall recognize any additional asset or liability that are identified in that review. So first you have to ensure all assets and all liabilities are recognized. Their fair values are correctly determined. If there is an NCI, its fair value is also correctly determined. And then, if required, you will make adjustment for any new asset or liability that you have identified. Okay. Now you come to question number 32. Question number 32. So much of data. On 1st April 2015, A Limited acquires 80% of the equity interest of B Limited, a private company, in exchange for cash of 150 million. So it is the consideration paid for 80% share. Because the former owners of B Limited needed to dispose of their investment in the company by a specified date, they did not have sufficient time to market B Limited to multiple potential buyers. Management of A Limited initially measures that the separately recognizable identifiable asset acquired and the liabilities assumed as of the acquisition date in accordance with requirement of IFRS 3. The identifiable assets are 240, liabilities 40. So what is net asset? 200. Are you with me? Your net asset is 200 in this paragraph. A Limited engages an independent consultant who determines that the fair value of the 20% NCI is 45 million. Good, they have done the calculation. So I have paid 150 plus NCI 45. So total 195, whereas the net asset is 200. So what is the result? Amount of B Limited's identifiable net asset is 200 million, exceeds the fair value of consideration transferred 150 plus non-controlling interest 5 by 5 million. So what you will have to do, A Limited will review the procedure it used to identify and measure the net asset acquired and liabilities assumed, and to measure the fair value of both the NCI and the consideration transferred. After that review, A Limited decided that the procedures and resulting measures were appropriate. So it says no change required. The deferred tax liability arising out of the asset acquired is rupees 3 million. So we have to credit one more account called deferred tax liability account. Show the accounting entry. So what accounting entry we will pass? Write down asset account debit 240. Asset account debit 240. To liabilities 40. So you first record what you have taken over. If there is any deferred tax asset or liability, then that also you consider to deferred tax liability 3. Okay. And then you also record consideration transfer to bank 150. After that you record NCI 45 to NCI 45, non-controlling interest. And then if you are getting a difference, that difference you recognize in profit and loss account to P&L account balancing figure 2. Okay. Now we will continue tomorrow.